Yes, so the question reads, I hope you are here. The following are the group income statement and the group statement of financial position of 𝗙𝗌𝗄, a group of companies for the financial year which ended 31st of October 2016. So we have 𝗙𝗌𝗄 group income statement for the year which ended 31st of October 2016. We have the revenue, and actually we are told these are credit sales. We have the cost of sales, gross profit, other incomes which include investment income, share of associate profit after tax. We have expenses which include distribution, administrative, finance. We have the profit before tax, income tax expense, profit for the year, which is profit for the year. And we are given the profits attributable to the holding company and the non-controlling interest. And then we have 𝗙𝗌𝗄 Group statement of financial position as at 31st of October 2016 and 2015. So we are given the non-current assets, which include PPE, intangible assets, including goodwill, investment in associate and also other investments. We have the current assets, which include inventory, trade receivable, short-term investment, cash balance. And then we have equity, which comprises of ordinary share capital, revaluation, reserve, retained earnings, share premium. We have non-controlling interest. Under the non-current liabilities, we have raw notes. Under current liabilities, we have trade payables, a bank overdraft, and then we have the current tax. And then we have the additional information, number 1 up to note number 6. So what are we required to do? We're required to prepare the group statement of cash flows in conformity with IAS 7 for the year which ended 31st of October 2016 using the direct method of presentation. Using the direct method of presentation. Remember what you said is that if you come across a question for cash flow in an exam setup, on actually any question, we say it is not advisable to start with the workings. That's why you can see even I've not gone through the additional information, because if you do that, we may be required to do some workings. We say it is not advisable to do that. You don't have the time to do the workings, and also you answer the question. So what we said, go straight to what we are required to prepare by the examiner, and then you do the workings on need basis. What do you need to compute? You compute it, post it in your cash flow and so on. But never start with those particular workings, because they will consume all your time, and by the end of the day, we said that they are not supposed to be what? To be marked. So therefore, what you just need to do in that case, you just have the title of what you're required to prepare. Like in this case, we are required to prepare the group cash flows. So the name of the group is 𝗙𝗌𝗄 Group. 𝗙𝗌𝗄 Group. This is the group or the consolidated statement of cash flows, which is for the year which ended 31st of October 2016, 31st of October 2016. Then, after having that particular heading, we said you should have now the other 3 subheadings here. So because we know that in preparing the statement of cash flows, we determine the cash flows from 3 activities, starting with the cash flows from operating activities. So we need to have 2 columns here, and I hope you can see the figures are in million of shillings and in million of shillings. Now, what is the difference between now the direct and indirect method of presenting a statement of cash flows? That is now what you need to remember. The difference between the direct and indirect method, direct and indirect method, only is how, or basically the difference is how we determine these cash flows from operating what? Activity. So means that in terms of how we determine the cash flow from investing, the cash flow from financing, we use the same approach under the 2 methods. So the only difference is here. So if you can recall, under the indirect method, we determine the cash flows from operating activities by adjusting the profit before interest and tax with a number of items. So we adjust this particular profit with the non-cash items, which were added or deducted in arriving at this particular profit. which include depreciation, impairment, amortization, loss or gain on disposal. Actually, there is this acronym which we use, that is 𝗙𝗪, depreciation, impairment, loss on goodwill, amortization of intangible asset, gain or loss on what? Disposal. Also, we adjust a particular profit with changes in working capital. We use the acronym RIP, receivables, inventory, and what? Payables. And also to this particular figure, we list two items, tax paid and interest paid, and we get now the net cash flow from operating activities. That's how we determine the net cash flows from operating activities using the indirect method. But under the direct method, we determine this by considering three items here: cash received from the debtors stroke customers. So we also consider the cash paid to suppliers stroke creditors. And number three, we consider the cash paid for operating expenses. For operating expenses. Now, one of the challenge with this particular method here, the indirect method, and that's why you can see it's not that common, is that none of the item here is provided by the examiner. Remember, when using the indirect method, we said most of the items here will be provided. For example, you'll be given the profit before interest and tax, and actually you'll also be given a number of what? Items. So the challenge with this particular method is none of these particular items are given. We are going to look on how we compute them. And then now to this, we less the tax paid by the group, and also the interest. The interest, or in other terms, the finance cost, which was paid by the group. Actually, none of these particular items is given, maybe except this one, but we are going to see. And then now we get the net cash flows from operating activities. So we are going to come back and basically we compute all those items. So after doing that, we proceed and we determine the cash flows from investing activities. And actually, in this case, we said that when talk about the financing activities, so these are those particular activities which relate to acquisition of assets, and actually disposal of assets, acquiring assets and disposing assets, subsidiaries which were acquired, or subsidiary acquired, subsidiary disposed, and also investment income which was received. So those are basically some of the items which we consider here. So then leave some space there, and then you have the other subheading for determining the cash flow from the financing activities. From the financing activities. And actually, you also have to remember that all the items which we include here, or basically which we use in computing the net cash flows from financing activities, we get them from the equity section, and the non-current liability section of the statement of financial position. So leave some enough space there, not a big space. And finally, we said you come and record cash and cash equivalents, balance brought down, which is basically at the start of the year. And then you also record cash and cash equivalents, balance carried what? Down, which is equally at the end of what? Equally at the end of the year. So remember, you have two columns here. So, and actually what we said is that in these particular questions for cash flows, there are those particular free marks. And actually what we said is that what you need to do when tackling this particular question in an exam setup, those are the free marks, or those are the marks you should be able to correct first of all. Sasa? Yes. And actually we said some of the free marks always start by recording these two items here: the cash and cash equivalent at the start, and the cash and cash equivalent at the end of the year. Because here we said you consider like how many items? 3 or 4. Cash and cash equivalents. You consider how many items here? You consider one, cash in hand, Roman 2, cash at bank. You also consider the short-term investment, and the bank OD, the bank overdraft. All the first three items, these are items of current asset, and the bank overdraft is an item of current what? Liabilities. Sasa? Yes. So can we do that? First of all, we determine the cash and cash equivalent at the start and cash and cash equivalent at the start. So we go to where in our statement of financial position, specifically where we have current assets. Under the current asset, which item of cash and cash equivalent do we have there? I think we have two items. Is that the case? We have the cash balance and short-term investment. So I think let's do away with these two words here. So, but you have to remember, brought down is the opening balance, carried down is the closing. So for the cash and cash equivalent at the start, and it's also important to note that in our statement of financial position, or we're given statement of financial position for 2 years, 2016, 2015, we say these are opening balances, these are closing balances, opening balances, closing balances. So the cash and cash equivalent at the start, we start with the short-term investment, which at the start of the year was 0. What about the cash balance? It was 10. And then we go to where we have current liabilities to angalia kama tuko na bank overdraft. Do we have a bank overdraft? We check whether you have a bank overdraft under the current liabilities. Under the current liabilities, I can see we have an overdraft of 980. So that overdraft, we included here, but basically we know this money which is owed to the bank. We record it there as a negative. So meaning that the cash and cash equivalent at the stand will be 970. Will be 970, and basically this is a negative. Is a negative. If we rate it there as a positive, is long, is a negative. So we do the same at the end of the year. The cash and cash equivalent at the end of the year will comprise of the cash balance, which is 20, short-term investment, which is 500, minus overdraft, which is 850. 850. Still, that will give us negative something. Negative 330. Negative 330. Is that the case? Negative 330. Yes, that will be our cash and cash equivalent at the end of the year. Now, having that then, what we need to do, because there is nothing we are recording here, I think from the income statement, under the direct method, these items we have to compute them. So what we need to do first of all, we need to go through the additional information. Basically, we see whether there are some obvious entries we can get and which we can record here. That's what we said. Even before you do the workings, you go through the additional information, you see whether there are some obvious entries which you can get and you record them here. So let's do that. In note number 1, we are told an item of plant with an original cost of 850 with a net book value of 450 was sold for shillings 320 million during the year. So in this case, we said anytime the company sells an asset, that is an investing activity. That is an investing activity. And the cash which was received, you record it here. So you come here and you say there was a sale, or in other terms, there was disposal of a plant. And we said what we consider here is the proceeds. How much amount was received from the sale of the asset? In that case, we are told is 320, and this is a cash inflow. That is a cash inflow. So remember, if, for example, we are using now the indirect method, we were supposed to determine the loss or the gain on disposal, and actually we consider that here. We adjust that now to the profit. But take into account, we're using the direct method. The only item we consider here is the money received from the sale of the asset. Number 2, we are told other investment was sold for shillings 300 million during the year. So which are these other investments? If we go back to the statement of financial position, specifically under the non-current assets, you can see we have property, plant, and equipment, intangible asset, investment, which include investment in associate and other investment. The other investment at the start of the year had a carrying amount of 250, but at the end of the year, those other investment are zero. It means that they were disposed. Anytime the company sells as investment, that is also an investing activity. A sale of investment, and equally what you consider here is the proceeds. The proceeds. The investment was sold at how much? In note number 2, we are told they were sold at 300, which is still a cash inflow. We are done with that. Let's move to point number 4. We are told during the year which ended 31st of October 2016, 𝗙𝗔𝗥 Limited acquired an 80% of the share capital of Sahani. And then you're told the assets of Sahani Limited were as follows. So basically, you're given the assets and liabilities of Sahani, which is the subsidiary which was acquired during the current year. We are given the asset which comprises of PP, inventory, receivable, raw notes is a liability, trade payables, bank balance, tax, all those are liabilities. Yes, so we are given that information there. Yes, so before you go to note number 2, to note number 4, sorry, remember what we said. In case the parent company acquires a subsidiary, that one is also considered here as an investing activity. And actually what we consider here is the net cash outflow. The net cash what? The net cash outflow, because we said once the parent company acquires a subsidiary, the parent company will pay some purchase what? Consideration. So the purchase consideration, take the purchase consideration, but in this case, we say that this particular subsidiary which has been acquired will be having some cash balance. So therefore, how do we compute the amount to be included here? We said we take the cash which was paid, like in this case, assuming it is X, minus the cash balance which our subsidiary had on the date of acquisition. So that is now what we consider here. But I think in that point, you are not given that information. So let's go to point number 4. And in point number 4, we are given information about the PP, the cost, the accumulated depreciation, and the net book values. Okay, I think there is some information we record to compute there. Mostly, we said as far as the PP is concerned, there is something which the examiner will not have given you, mostly the PP which were acquired during the current year. And actually, you prepare an account called the PP to determine the PP acquired during the current year. So and then you're told in the other paragraph, the cost of the PP of Sahani Limited on the date of acquisition was 1,000 million and accumulated depreciation of 400. And then you're told during the year, which ended 31st of October 2016, there was a revaluation gain of 100 million attributable to the holding company. So in that case, what you're going to do, we are going to prepare the PP account. And the objective of preparing that account is basically to determine were there some PP which were acquired. So that is something we are going to compute later on. But I'm saying, first of all, you record the obvious entries. And then in note number 5, we are told the total purchase consideration of 𝗔𝗙 Limited. That point had a problem. So 𝗔𝗙 Limited is referring to this subsidiary which was acquired, which in note number 3, I hope you can remember its name was Sahani. So, but there you can see it is referred to as S. So that S is now the subsidiary acquired in number 3. So the total purchase consideration of Sahani Limited was 450 million. So we are given the purchase consideration which was paid for 50 million, which was paid by issuing shillings 100 million worth of ordinary shares. So this was paid, number 1, through share exchange. And the shares which were issued by the parent company had a value of 100 million. And the balance paid in cash. So the amount which was paid in cash, the cash consideration automatically was 350 million. So that if you add the two, that will give us what? That will give us 450. So what we consider here as far as the acquisition of the subsidiary is concerned is the amount which was paid in cash. So the amount which was paid in cash, which is 350. And then we also need to go back to note number 3. We check this particular subsidiary which was acquired, was it having some cash balance? The subsidiary which was acquired, because I've said what we consider here is what was paid, which is a cash outflow, minus any cash balance which the subsidiary was having. As per note number 3, was it having any cash balance, this subsidiary? In fact, it had an overdraft. So therefore, what we do, because you can see it didn't have a cash balance, it had an overdraft. That overdraft we come and we add it to this. So, but if it was a positive cash balance, we come and we erase it there. We do what? We erase it so that we get the net cash outflow. So in this case, the net cash outflow will be this, which was paid out, and then the parent company acquired a subsidiary which had an OD, a bank overdraft of 100. So therefore, the net cash outflow here will be 450. Will be forward 50. We have taken what was paid in cash, negative 350, and then this subsidiary which was acquired, it had a negative cash balance of 100. So the total net cash outflow will be 350 plus this one, which is still a cash outflow. So that's why we are considering negative forward with 450 there. So we don't consider the amount which was paid in cash because it's a non-cash transaction. I think basically that's what we have in note number 5. Then in note number 6, we are given information about depreciation. We are told depreciation and the depreciation and the loss on sale of plant are included in the cost of sales, are included in the cost of sales. Yes, I think in this case, those are the obvious items we are given. So basically, it means that we have now to compute the other items. We have to compute the other items. So what I want us to do, I want us to start with which working. Let's start by this account, preparing this account here, the PP account. The PP account, because it's affected by so many notes. And I've said the objective for preparing this account is to determine whether there are some PP which were acquired. And I want us to prepare this one together with another account which is called the accumulated depreciation account. Accumulated depreciation account. And in this case, it is important to note that if you are preparing these two accounts separately, this particular account here, the PP account, you prepare it at cost. But if you're not preparing this, it basically means that this account will prepare it at net book value, because depreciation for PP will not be recorded here, but they are supposed to be recorded here. Sasa? Yes, in fact, I want us to, can we first of all prepare this one? Let's first of all prepare this one. So this is an accumulated depreciation account. So the accumulated depreciation account, this account has a credit balance. And you're given the accumulated depreciation in note number 4. Note number 4, we have accumulated depreciation. At the start of the year, it was 29. And then the accumulated depreciation at the end of the year was 34. So what else do we record in this particular account here? On this side, we record any accumulated depreciation of the subsidiary acquired. On this side, we record any accumulated depreciation for subsidiary disposed. So in our case, we know there was no subsidiary which was disposed. We only have subsidiary which was acquired. And then on this side, we record the depreciation for the current year, which was taken to the income statement. So can we go to note number 4? In note number 4, the last paragraph, we are told the cost of a PPE of the Sahani Limited on the date of acquisition was 100 million. That is the cost, and accumulated depreciation of 400. So the accumulated depreciation for the subsidiary was acquired was 400. And that's why if we go to note number 3, the PP of the subsidiary acquired, you can see they had a net book value of 600. So this 600 is arrived at using the values we have in note number 4, paragraph 2, where we are given the year cost, 1 million, and accumulated depreciation of 400. So that means that the net book value, this one, is arrived at as the difference between those two values. So the accumulated depreciation for the PP for the subsidiary acquired was 400. And I think this is the only item which will affect the, no. There is another item. There is another item which you also need to capture here, and that is the accumulated depreciation for the asset which were disposed. Because the accumulated depreciation for the asset which was disposed was part of the opening balance. Once the asset have been disposed, we need to remove the accumulated depreciation here. So we have that information in note number 1. The item of plant which was disposed, it had an original cost of 850, net book value of 450. So what was its accumulated depreciation? the accumulated depreciation of that item which was disposed. Remember, net book value is equal to cost minus accumulated depreciation. So we have the net book value, 450. We have the cost, 850. So what we don't have is the accumulated what? Depreciation. So that one would be 400. And because it was part of this and the asset has been disposed, we need to eliminate it from the opening balance by debiting our account. So what we want to determine basically is this depreciation. Is that depreciation? Is that depreciation? There is somewhere we are going to use that. I will show you where. So that will give us an amount of how much? This will be 38 minus minus whatever you have there. Is it 500? The balancing figure? Yes, 500. So I'll show you where we are going to use this, because remember, we are not using now the indirect method. If we are using the indirect method, that could have been adjusted in our profit there. So that is not what we are doing. So then let's prepare this particular account. And basically I've said we are going to prepare this account at costs, at cost. So where do we have the cost of the PP? We have this in the note number 4. So the cost of the PP at the start, not the net book value, but the cost at the start was 59.50. The cost at the end of the year is 72. Then in this account, we record a number of items. On this side, we record any revaluation gain. We equally record acquisitions. And if we go to note number 4, the last sentence of note 4, we are told during the year which ended 31st of October 2016, a revaluation gain of 100 million attributable to the holding company, or there was a revaluation gain of 100 million attributable to the parent what? Company, a revaluation gain of that. And then what we record on this side are the assets which were disposed, and basically at cost. Everything here has to be recorded at cost. We go back to note 1. The plant which was disposed, it had an original cost of 850. What we also record on this side are the PPE for the subsidiary disposed. That is PP of the subsidiary disposed. So do we have a subsidiary which was disposed? No. And there is also something I've forgotten to record here, PP of the subsidiary acquired. And also those PP must be recorded here at cost. We have that in note number 4, the last paragraph. The cost of the PP of Sahani Limited, which is now the acquired subsidiary, was 1,000 million. So the cost of the PP of the subsidiary acquired was 100 million. So what is missing in our question here, or in our account? What is missing are the PP which were acquired, and that is now what we want to determine, and we record it here. That will give us what? Give me that balancing figure. Give me that balancing figure. The balancing figure. What are you getting? Yes, I'm given 1,000. So 1,000, this represents the PP which were acquired. We record it here. And basically that is a cash outflow. Yes, so that account was affecting what we have in note number 1. Note number 2. Okay, note number 2 is about investment. Note number 3 is about the subsidiary which was acquired. Note number 4, PP. Note number 5. Note number 6. Yes, I think majorly that was affecting so many notes. Okay, so before we equally come back and compute these items here, Can we first of all deal with this? We go to equity and non-current liability section. We see what we need to capture here. So first of all, let's go to where we have equity. The first item of equity we have there is ordinary share capital. So for the ordinary share capital, you can see we have an increase from 15 to 2,000. That is an increase of 500. So basically this, remember, is the share capital of the parent. What we record in the consolidated statement of financial position is the ordinary share capital of the parent. So the ordinary share capital of the parent company increased with 500. But we also have to recall that when the parent company acquired this subsidiary, that is 𝗂𝗍, the parent company issued some shares which had a value of 100 million. 100 million as per note 5. So these shares which were issued by the parent to pay the purchase consideration, remember, there was no cash which was received in relation to those shares. So what we consider here are the shares which were issued for cash, which will be equal to the increase minus the shares which were issued to pay the purchase consideration. So what we consider here is 400. These are the shares issued for cash. So below that, we have the revaluation reserve. Do we consider that here? No, these are non-cash items. These are non-cash items. So then below that, we have the retained profit. Anytime you see the retained profit, you have to remember very fast, we use this to compute the dividends paid. The dividends paid by parent company. How do we compute this one? Very simple. We take the retained earnings at the start of the year, which is 1,200, retained profit or the retained earnings at the start of the year. And then to this, we add the profit for the year attributable to the parent company. Profit for the year attributable to the parent company. We get that from the income statement. Profit for the year attributable to the parent company ni ngapi from the income statement? Profit for the year attributable to the parent company or attributable to the holding company. How much is that? From the income statement, that should be the last item in the income statement down there. Yes, that is a figure of 1650. So we don't consider the full amount of the profit. We only consider the profit attributable to the parent, which is 1650. And then to this, we less the retained earnings at the end of the year, which is still under the equity section, 1740. 1740. So that will give us the dividends which were paid by the parent. That will give us a figure of what? 2850 minus 1740. Yes, so that will give us 1110, and that is automatically cash outflow. Cash what? Outflow. Let's go back to the equity section. Below the retained profit, we have the share premium. The share premium increased from 15 to 16. So we have increase in share premium. And actually the increase in share premium of 100, it basically means that these shares which were issued, they were issued at a premium. This premium also represents the cash received. Represents the cash received. Then below that, we have non-controlling interest. Non-controlling interest, we use that to compute the dividends which were paid to non-controlling interest. Dividends paid to non-controlling interest. So in this case, to compute the dividends which were paid to the non-controlling interest, we said we have to prepare an account called the NCI account. NCI account. NCI account. So in preparing this particular account, we, under the equity section, I hope you can see we are given the NCI at the start and also at the end. The non-controlling interest at the start, 300. The non-controlling interest at the end is what? 500. 500. So what else do we record in this account? On this side, we record the NCI share of the net asset of the subsidiary acquired. We also record NCI share of profit. And then on this side, we record NCI share of net asset in the subsidiary disposed. Do we have a subsidiary which was disposed? No. So first of all, let's record this one, NCI share of the profit, or in other terms, the profit for the year attributable to NCI, which is in the income statement, the last item. Profit for the year attributable to NCI, which is 150. Which is what? 150. Equally, we know in note number 3, there was a subsidiary which was acquired, and that subsidiary, the parent company, acquired 80%. So meaning that the minority shareholders have an interest of 20%. So what we need to do here is to compute the share of net assets in that subsidiary which was acquired, which will be 20% of the net assets of that subsidiary, which is 500. So this will give us what? This will give us 100. So then what we get as a balancing figure on this side are the dividends which were paid, the dividends which were paid. So this will give us what? This will give us 550. And I think the balancing figure there, the dividends paid to minority shareholders, is it 50? 50? 50. The dividends paid to minority shareholders. So I'm trying to hurry because of time. We need to finish this particular question. So there are some items which we are yet to compute here. That's why I'm trying to rush. Okay. So I think we are done with the non-controlling interest. Then below that we have row notes. So for the row notes, we can see it increased from what? From 500 to 17. So the reason why these row notes may increase is due to 2 reasons. One, the subsidiary which was acquired may be having a row note. That is the first thing you need to check in note 3. And I can see that subsidiary acquired had a row note. And the other reason which causes the row note to increase is because there was issue. So if you check on the row note, which was the row note for the subsidiary acquired, it was 250. But you can see the row note increased with a figure of 12. So meaning that what we need to consider here are the row notes which were issued for cash, issue of row notes. So we take the increase, which is the 12, but now we deduct the row notes for Sahani because there was no cash received from this. So we are only considering the row notes issued for cash. The increase, 12, minus the row notes of the subsidiary, which was acquired, which is 250. And that will give us what? That will give us 950, which automatically is a cash inflow. And actually, that's why we get all the items now, which we consider here under the equity and what? And current liabilities section. Okay, so I think we are done with that. So then from here, maybe we need to check whether there is any other item we need to include here. Specifically, I think we can go to where we have assets. Let's go to where we have assets. Under the assets, what do we have? Under the asset, we have specifically non-current asset, we have PPE. And I think we have dealt with that. And then below that, we have intangible assets. Maybe for the intangible asset, we can prepare that account. We determine, well, there are some intangible assets which might have been acquired. So the intangible assets at the start of the year had a value of 25. The intangible assets at the end of the year had a value of 2,000. So what do we record in this account? On this side, any intangible asset for the subsidiary acquired. If you check on the subsidiary acquired in note 3, was it having any intangible assets? Subsidiary acquired, was it having any intangible assets? No. On this side, we record any intangible asset for subsidiary which was disposed. There was no subsidiary which was disposed. And then because we are told that intangible assets include goodwill, we're also going to include the goodwill for the subsidiary acquired, that is Sahani, will be debited in this account because that will increase the intangible assets which were there at the start. And actually, the computation of the goodwill for Sahani is quite straightforward. We take the purchase consideration, which was paid in acquisition of Sahani, and that purchase consideration, we have it in note number 5. I'm interchanging those balances. Oh, the opening balance is 2,000. And the closing is the one which is 25. Okay. So, so I'm saying we need to compute the goodwill on acquisition of Sahani. And this is quite straightforward. We could take the purchase consideration paid minus fair value of net assets acquired. So, and here we are using the partial goodwill method because there is nowhere we are given the NCI at fair value. So, the net asset of Sahani as per note number 3 was 500, and then we take the net asset acquired by the parent, which is 80. So this will give us 400. So the goodwill on acquisition was 50. So that goodwill on acquisition, we do what? We debit it in this account. We debit it in this account. And then on this side, if a balancing figure on that side, it should be impairment loss. If we have a balancing figure on this side, this can only represent the intangible asset which were acquired. And I don't think we have anything affecting this account. So where do we have the balancing figure? I think we have a balancing figure on this side of 450. So that automatically represents acquisition of intangible assets. 450, which is equally a cash outflow. So I think we are done with that one. Then below the intangible asset, we have investment. We have investment in associate and other investment. Remember, you have already dealt with other investment because they were sold. So in relation to investment in associate, we said there is something which we compute and we include here, the dividend received from associate. So how do we compute the dividends received from associate? This one is quite straightforward. We don't need to prepare an account. We take investment in associate at the start. Investment in associate at the start of the year, which is 500. So that is the investment in associate. And then to this, we add the share of associate profit, which is in the income statement. Can we go to the income statement? Below the gross profit, you can see we are given share of associate company profit, which is 200. So we add that to the opening balance, investment in associate at the start, plus share of profit in associate, and then we less investment in associate at the end of the year, which is 650. So this gives us the dividends which were received from associate, which is considered as a cash inflow. Yes, I think we are done with all non-current assets. And I think there is also another item which we include here, which is in the income statement, and that is the investment income received. Investment income received, which is below the gross profit. The investment income received, which is below the gross profit, a figure of what? 250, a figure of 250. And I think now having that, what we need to do now, we just now need to compute these items. I think this is now what is remaining. This is what now is remaining here. What is remaining here? Let's do that. Let's compute this. Let's start with by computing the first item here, the cash received from debtors or customers. Cash received from debtors or customers. Now this one is quite simple because we compute this by preparing something called the trade receivables account. The trade receivables account. This is how we determine the cash received from debtors or customers. So the first thing we record in this account is the opening balance, the trade receivables at the start, and the trade receivables at the end of the year. Then on this side, we also record receivables of the subsidiary acquired. In case there was a subsidiary which was disposed, you record the receivables of that subsidiary disposed. In our case, we know there was no subsidiary which was disposed. And then on this side, we record credit sales, or basically the credit what? Revenue. And the balancing figure which will be on this side is the cash which was received from debtors. From debtors or who? A customer. So this one is quite simple. Quite simple. Can we go to where we have current assets? Under the current asset, the second item we have is the receivables. The receivables at the start was that 150. The receivables at the end is 39. So that's what we have. And then we go to note number 3. In relation to the subsidiary which was acquired, it had the receivables of 300. Okay. And then we get this one in the income statement. If we go to the income statement, we have revenue. And your total revenue, this was from credit sales. So mean that the credit sales was 530. Do we have a subsidiary which was disposed? No. So it basically means that the balancing figure on the credit side, this one represents what represents the cash which was received from debtors or who? Customers. From debtors or customers. So the cash received from debtors or customers is what? The balancing figure. What are you getting here? What are you getting here? I'm getting a figure of 25,080. So that's basically how we determine the cash received from debtors or customers. So the computation of that one is quite simple and also straightforward. Okay. So then from here, we need to determine this one. The cash received, the cash paid to creditors or suppliers. And actually we compute that by preparing an account which is called trade payables account. The concept is the same as the one we have used here. Payables is a liability. So therefore the opening balance is a credit balance. We record the opening balance for payables on that side. The closing balance here. So then on this side, we record payables of the subsidiary acquired. We have that in note number 3. Then on this side, we also record the credit purchases. So this is one of the item which now which makes the computation of this one to be a little bit complex because the examiner will not have given you this. So you have to compute it. And then on this side, we record payables of the subsidiary disposed. So in our case, there was no subsidiary which was disposed. So the balancing figure on this side is the cash paid to suppliers or basically creditors. So can we therefore first of all record what we have? So first of all, we record the opening and closing balances for payables. Where do we get that? We get that under the current liabilities. So the payables at the start were 1990. At the end of the year, they were 2270. We have payables for the subsidiary which was acquired. In note number 3, payables for the subsidiary acquired 400. Do we have a subsidiary which was disposed? No. So this is now what you're not given. That one we have to compute it. And actually the computation of that one is the one which is maybe a little bit which requires some workings here. Now, where do we include purchases? We know purchases is included in the cost of sales. So how do we compute the cost of sales? We compute the cost of sales by taking opening inventory. We add purchases. These purchases, we don't have it. That is what we want to compute. So we less closing inventory. That's what we know. To this, we also add depreciation. And actually, that's why note number 6 was given to you. Note number 6, depreciation and loss on sale of plant are included in the cost of sales. So, and I think we have computed this depreciation for the current year. To this, we also add loss on disposal, loss on disposal, loss on disposal. In case there is a gain on disposal, we less it here. So we know there was no gain on disposal. And then we get what? The cost of sales. Cost of sales. So we have everything here except this one, So can we first of all record the opening and closing inventory? Opening and closing inventory is given in the statement of financial position under the current assets. Under the current assets, the inventory at the start is 1020, 1020, 1020. There is something I've forgotten to add here. So before we list the closing inventory here, we also add the inventory of the subsidiary acquired. You add the inventory of the subsidiary acquired. In case there was a subsidiary disposed, you list the inventory for subsidiary disposed. So before we list the closing inventory, we need not to forget that. So opening inventory 1020, closing inventory is 15. This one is 15. That one is a deduction. And then if we go to note number 3, the subsidiary which was acquired had an inventory of 400. So that one we add it because it increases the goods available for sale. We have already computed the depreciation for the current year. The depreciation which you have computed, was it 500 from the accumulated depreciation account? Was it 500? Depreciation. We have computed that by preparing accumulated depreciation account. Accumulated depreciation account. Was it 500? Yes, 500. And then from note number 1, I think we can compute the loss on disposal of that plant. The plant which was disposed, it was disposed at 320. That is the amount it was sold at, but its net book value was 450. This is the proceeds. This is the carrying amount. It was sold at a loss. If you sell an asset at an amount less than its carrying amount or net book value, it's a loss. So this is a loss of what? 130. The loss on disposal of 130. 130, is that the case? 130, yes. So that one should be added there. In our case, we don't have loss on disposal. We don't have gain on disposal. And then finally, we have the cost of sales. The cost of sales in the income statement. Cost of sales in the income statement is 18,140. 18,140. So you can see in computation of all these, only one item which is missing, and that is purchases. That is now what we want to determine here. So that we record it there. So how do you get that one? So you work out all these, and then you get the difference between what you're going to get after working all this with the final figure there. So we have 1020 plus 400 minus 1500 plus 500 plus 130. So I'm getting 550. And then we get that the difference between 550 and 18,140. I'm getting 17,590. 17,590. Are you getting 17,590? 17,590. Yes. 17,590, that will be our purchases. And because the question is still silent, we assume that was or basically that was credit. Sasa, yes. And then what we need to do, we balance our account, the balancing figure. On this side, it represents the cash paid to suppliers or creditors. We have 1990 plus 400 plus 17,590 minus what we have on the debit, 2270. So I'm getting 17,710. 17,710. 17,710. Confirm whether you're getting that value there. Yes, 17,710. Yes. So I think we are done with that one. That is the one of the items which is quite involving. And then the cash paid for operating expenses. Now, for the cash paid for the operating expenses here, you consider two expenses, the distribution cost and the admin expenses. The administrative what? Expenses. So actually those particular expenses, we just get them from the income statement, but it's very, very important for you to check whether there was something like impairment loss. Because mostly if there was an impairment loss, that is usually included as part of the administrative expense, but we know impairment loss is a non-cash item. Is a non-cash what? Item. So mean that if you're given a demand, for example, of 250 million, and you're told impairment loss of 20 million was included there, you need to less that impairment loss because it's an expense, but that didn't involve cash outflow. You only consider those expenses which involve some cash what? Outflow. And remember, in our case, there was no impairment loss on goodwill as per the intangible asset account we prepared. So therefore, here we are considering two expenses from the income statement: distribution, which is 250, and administrative expenses of 26 what? 40. These, remember, are cash outflows. And then finally, we consider these two items. We determine tax paid and the interest paid. So for the tax paid, I think this one is quite simple because what we only have is what? Okay, for the tax, I think we have to prepare that account. But for the interest, before we prepare the tax account, for the interest, I think this one is quite straightforward. Interest, because what we need to consider is the finance cost from the income statement, which is 750. And then under the current liabilities, we determine whether we check whether we have any accrued interest. Do we have any accrued interest under the current liabilities? Any accrued interest under the current liabilities? No. It basically means that the interest which was paid here was 750. But I'm saying for tax, we have to prepare that account because there are a number of items affecting that. Not so many items. So the tax account, so that we determine the tax paid. So for the tax account, remember you said the number of items which you record here. You need to check whether we have a deferred tax and current tax. At the start of the year, you record them on that side. You do the same at the end of their deferred tax, current tax. And then you need to check whether there was a subsidiary which was acquired. Was it having a tax liability? Record it on this side. And the tax which the company was supposed to pay during the current year, which is in the income statement. On this side, in case there was a subsidiary which was disposed, was it having a tax liability? Record it here. In our case, no subsidiary which was disposed. And the balancing figure on this side is the tax paid. And that is what we want to determine. So first of all, if we go to where we have non-current liabilities, you'll see that we don't have deferred tax. We don't have deferred tax. But under the current liabilities, we have current tax. Current tax at the start of the year was 11. Current tax at the end of the year was 12. And then if we go to note number 3, the subsidiary which was acquired had a tax liability of 50, a tax liability of 50. And then we go to the income statement. In the income statement, how much is the income tax expense for the year? In the income statement, below the profit before tax, income tax expense for the year is 14. So what we do, therefore, we balance our account to determine the tax paid. On the credit side, we have 11 plus 500 plus 14 minus what we have on the debit, which is 12. And I'm getting the tax paid as 18. So confirm whether you're getting the same value. Tax paid of what? Tax paid of what? Tax paid of 18. Is that what you're getting? 11 plus 50 Oh, no, I've added 500. Should be 1350. I think that is correct. I think this should be 1350. 1350, not 18. Yes, should be 1350. So basically that is it, that what is required in that particular question. If that question now you do it like that, you'll have scored all the 20 marks. So therefore, in case you're required to use now the direct method, I hope you can see here there are some free marks, like this one. The cash paid received from the debtors or customers, that one you should get it. And basically this one. So I know the one which is a little bit demanding is this one. The cash paid to suppliers or who? Creditors. And also these two items, make sure you get them. And also a number of items here and there. So basically that is it. That what was required as far as that particular question is concerned. And I think for today, we're going to stop at that particular point. So basically that means that I think we are almost now done with the revision for cash flows. I don't think we will come back to that. So therefore, what you just need to do is basically to perfect on the same. That is cash flow, such that if you come across a question on this, make sure you get good marks because I think this is an area whereby you can be able to get is an area which is not that complex, Okay, so I'll be able to check that video on this. I'll be able to check the last video